Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Wow, what an introduction. I feel like I'm going to let you all down. Oh, well. I can try. Oh, feel free to give us a call, like the guy said, 216-901-0945, 216-901-0945. And great week. I'll tell you, some things have really turned and started going well. I got a phone call already, but that's cool. 216-901-0945. If you have a question, please feel free to give us a call. If you go to my website, you can sign up for the upcoming seminar. There are a lot of spaces left, which is not uncommon for this time of year. But we're going to be talking about the 10-minute retirement plan and stock picking 101. We'll talk about that a little bit on each radio show going forward because it's very important. People have made this way too complicated. Retirement planning is not that sophisticated. It really isn't. I mean, but it can be as complicated as you'd like it to be. Let me put it that way. So we're going to be talking about a 10-minute retirement plan, and I've got a little worksheet. Everybody there will be able to do a retirement plan by the end of that program. How's that? Yeah, I'll show you how you can, what you can anticipate to be able to spend during retirement, how much you want to spend without running a big risk of running out of money. And that's a big deal. Because I know everybody wants to go back and look for a job in their mid-80s. Just kidding. And it's just not that hard. It's really not that hard. And in fact, the two things you just have to have a fairly vague idea. You don't have to have an exact idea. You need to have an idea, though, of approximately how much you're going to get in Social Security or a pension, any other sources of income you might receive. Sometimes people have real estate and sometimes they have a business. They may want to sell that business at some point in time. But basically, just an idea of what kind of income sources you'll have and then how much you have in savings, whether that's 401k, defined benefit pension plan that you're going to take in a lump sum, or if you're trying to make that decision where you're going to do that or not. And that's all you really need, those two items. And then of course, we have your life expectancies and all that, and I'll actually give you a little, I'm not sure if I should do that, is tell you how long you might live. No, I'm kidding. I'll do that. I'm pulling this off of the, there are lots of sites online. You can get mortality rates, but anyway, you can go to the website and sign up for it. We're also going to be talking about stock picking 101. That also is not as difficult as people like to make it seem. And I guess I should tell you that it's actually not difficult to know the things that you can know. Most people sit around trying to figure out what you can't possibly know. And they wonder why it's so hard. And it's because you can't possibly know those things. And I'll give an example. How long is the next semiconductor going to last? For, let's say, just for PCs, because there are semiconductors in everything now. Your car has gazillions of them in it now. But let's say one specific semiconductor, how long do you think the useful life of that is? I'm going to tell you, maximum it's 1 season. Maximum it's 1 season. And if you're looking at a semiconductor manufacturer, they're going to have to come up with an all-new design. And they've got all these competitors out there around the world that are also trying to vie for that market share. They want to take business away from their competitors. That's what they're in business for. It's a competitive environment. And they'd better get the next design right. Okay, that's hard. You can't know that. Nobody can know that. They can know that they're going to try. And you can look at the past experience to say, okay, they've been successful in the past. That's not a guarantee of the future. Now, let me compare that to Hershey's chocolate. People are going to eat chocolate. I think I could support that company by myself. But I'll eat a lot of chocolate if their sales start to drop. So don't worry, Hershey's. I'm just kidding. But chocolate is a lot more predictable. Now, the costs of raw materials for chocolate, the cocoa powder, sugar, all the ingredients that go into that, the paper cost of packaging, those are things people don't think about. The healthcare costs of the employees that work there going up, it's something nobody ever thinks about, or at least nobody I've ever talked to other than a professional analyst. There are lots of things that you can't predict about that, but one thing you can predict is that people will eat chocolate. And they have different molds of different sizes, so if their costs go up too fast, they roll out the smaller molds. And I know that seems like facetious. It's not. It's actually how it works. And that's one of the reasons that in the long run, you've got to be invested in stocks, because stocks have the ability to adjust, the companies with the stocks behind them have the ability to adjust their prices and adjust their costs, and they will do it. They will try to defend their profit margin, and eventually they will, especially if it's an item like a chocolate or a company that's got a brand name and a soap product, those things that are a lot more predictable that people tend to consume a lot. So we're going to go into that in pretty good detail, and it's not that hard. It's not that hard. The hard part is you find a good company, and it's normally not underpriced. Most of the really good companies that people are familiar with right now are not underpriced. They're selling either at or slightly higher than they should be under normal conditions. And what are normal conditions? We'll get to that later. But what you're trying to do when you're picking stocks is you're trying to find companies that are relatively predictable. I mean, as much as they can be. They're still, like we've just been talking about, there are a lot of things that you just can't predict. But if you've got a company out there that has the ability to adjust, they can adjust their costs on the fly, that gives them a big edge. That's why companies like Clorox, Sherwin-Williams, Sherwin-Williams is a little overpriced, by the way. So is Clorox. So is Colgate-Palmolive. Procter & Gamble is actually okay. It's not super overpriced. Now, having said that, if something comes up unexpected that happens and they lose money, stock will probably suffer. In the short run, they'll make the adjustments, get the profit margins back in line. Remember, they're going to defend the profit margin. That's what they're going to do. They're going to defend the profit margin and try to expand it if they can. If they expand it, all the CEO and all the other corporate officers get a bonus. So that works out pretty good. And anyway, so we'll go into that more detail. I know you're driving around in your car, you're listening to this, and you're going, okay, it makes sense, but don't try to write this down. Please, just sign up for the seminar. It's a lot easier. I'll give a couple worksheets, and we're going to go through some stocks that I like a lot that I'm holding right now. Discover, the credit card company. We're going to talk about that one. I think it's actually, let me check on that, because this is one of those long-term holdings. It's not really a trade. And I keep forgetting what the symbol is. I've only owned this stock for about a year. Dude, I still can't remember the symbol. But anyway, yeah, there you go. Discover Financial Services, DFS. Yeah, it's actually below where I bought it. So it's down about 10% from where I made the purchase. Was up about 24% when I bought it. And if I were trading that stock, I would have been out of it with a small gain. But I looked at it and, this is one of the ones I'm going to hang on to. Why? Because understand credit cards. Everybody understands credit cards. They have very good profit margins. The company is extremely profitable, still growing. They missed on their numbers a little bit. And by the way, this is interesting. They missed on their numbers, so they didn't hit their profit expectations, and the stock didn't get cut in half like most stocks will. Okay, didn't get cut in half. It's around in the low 70s. Now it's in the high 50s, close to $60. That's not a huge drop for somebody who just missed their earnings report. Let that happen to a biotech company and see what happens. That stock will open up 50% lower and might end the day down 70% in a day. Okay, so that's the difference. What's the other difference? The credit cards are much more predictable than drug companies are. They're much more predictable. Okay, that's why it didn't get kiboshed like that. Okay, and I still like it. Valuation is still really low. It's actually one of the lowest valuations. What does that mean? Let's say you went into a neighborhood where all the houses were selling for $150 a square foot, and they're all pretty similar. Let's say it's it's a new development. Okay, so all the houses are extremely similar. $150 a square foot is the average. And all of a sudden, I'd say a year later, They're still selling around $150 a square foot. And then one comes up for sale around $90 a square foot. The first thing I got to ask is, okay, what happened? Did they find radon in the basement? What's going on there? And if you investigate and you find out that, somebody had to move quickly because they got a new job in California at a huge pay raise and really doesn't care what they get for the house, woohoo! That's what you do the same thing with stocks, by the way. So this company comes in, it's extremely healthy. Now it's selling at a valuation. If that house that was supposed to be $150 a square foot comes in at $120 or $115 a square foot, you're going, woo, got a good deal. Same thing with stocks. There are ways of telling where that stock should normally be. And we're going to cover that at the workshop because it's fun. Now, I am not advocating that you go out and manage all your own money this way. I think that's dangerous, especially if you're not a full-timer. You're not doing this full-time, you shouldn't do that. But you should know what to expect. And I think everybody should manage a small portion. Everybody should have a little tiny account. Could be really tiny if you're really afraid. But I think you should have the experience of trying to manage money. It makes you much more appreciative of what the process involves and over time, what you can expect from professional investors. I think it's just a great thing. But that's personal opinion. Feel free to disagree. Not a problem. This is America. You can carry any opinion you want. So anyway, that's Thursday, September 14th. It's going to start 6:30. We're going to go for about, probably 30 minutes on Stock Picking 101. That doesn't really need a lot. You're going to be amazed at how simple it really is. And I think you'll be amazed. So we're going to take a little break at that point in time, come back, do the 10-minute retirement plan. I'm going to everybody that comes there is going to get a free retirement plan. They will know exactly how to figure out the money they need to be able to maintain their lifestyle in retirement. Everybody. So, again, go to bullingtoncapital.com. You can sign up for the seminars. There's no cost to attend. Seating is limited. We've got a lot of seats left, though. I think we have somewhere around 84 remaining, so that's pretty good. And the Corporate College, if you've never been there, it's right off of Richmond Road over there by the, actually, it's by the Tri-Seas Normal Campus. All those new buildings and stores they've built around there. It's a nice location. And the facility is phenomenal. Everybody can see really well. You can hear really well. It's just a great place to hold these types of meetings. So again, that's Bullington Capital Management, and I'll stop. I'll get off the stump now, and actually open up the phones again, which have been open the entire time, by the way. You can go to or just dial us 216-901-0945, 216-901-0945, and I didn't even take a look at the headlines for the past few days. It's really kind of funny. That's another thing that when you know what you're doing, you're not going to have to pay as close attention to what's going on in the stock market because you know that 95% of all the data that comes out is not very meaningful. And I would hate to be the ones, by the way, that have to drum up views on a website that we're reporting on financial news because most of the time it's a snooze. And they have to create things in order to get people to clicks, or get the clicks that they need to sell their ads. So the vast majority of stuff that you hear is not very helpful. The stuff that you do need to know about doesn't take that much time to find and then filter, especially if you know what you're looking for. And this depends on how much you want to be investing in, how much time you want to spend doing that. And the vast majority of people today, by the way, don't have a whole lot of time, which is why you're also going to, want to come to the workshop. I am trying to put this down on paper so that you can download an ebook at some point in time. The things that are really important to know about the stock market, there are just a handful of them. One of them are that stocks are relatively unpredictable in the short run. That's what you really need to know. Whatever's done the best in the last 12 months is probably not going to do the best in the next 12 months. You should probably know that too. Looking at a short-term time horizon, like anything less than 5 years, is a mistake. You need to know that. I can't tell you how many people, and I get this all the time. How'd you do this year? who cares? To pick the top performing category this year, it's like the Super Bowl. A team rarely repeats, rarely, and it's not worth getting upset over. The team doesn't repeat all the time. The same thing with the categories in the stock market. They rarely repeat, and you really need to have exposure to just about all of them. And if you've ever in the number one fund, I'm sorry, some of your money will be in the number one category if you do it correctly. If you do it incorrectly, then you're always going to be chasing the ones that have just done the best. And performance is extremely cyclical, extremely cyclical. In fact, the things that performed the best 4 to 5 years ago, there's about a 2-year time period where momentum was just smoking the value-oriented stuff. Value-oriented stuff took over and then has been outperforming the past 3 years. And if you talk to most people today, they want to go in the value-oriented stuff. Why? Because it's done better. And I'm like, maybe you want to hold a little bit of both of that. And maybe actually you want to hold some of the categories that have been underperforming. Look at the international emerging markets and how long they've been underperforming until this year. They're up more than twice what the S&P's up. Okay, so you need some exposure there. We've been moving into that slowly. This year we've been adding positions to it, so that's a good thing. And I don't think it's over yet. By the way, I don't know that they'll actually be number one next year. They might. They're not. Occasionally you get a 2-year cycle. That's nice. You go back to the late 80s. There was a 3-year cycle where international outperformed the S&P. That was really nice if you were in it. Yeah. So, but they're normally not the number one. So you break that down a little bit farther. There will be. It doesn't happen that often where one category will actually repeat the second year, and none of them have repeated 10 years in a row. So that's ever in the history of all the world stock markets all over the world. So looking at that past performance, got to be really careful how you're looking at that, how you're analyzing it, what you're taking it to mean by. It's a lot of stuff there. It's actually, when you look at it, it does get a lot simpler the longer you've done this. We've talked a lot about in the past about doing an equally weighted portfolio versus a market cap weighted. And that's kind of a big deal. There are other ways to do that now. That's one of the really cool things I see, the developments I've seen in the market over the past 4 to 5 years, which I guess we'll have to wait until after these commercial messages to talk about in more detail. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned.
It's my favorite thing.
And we're back. So, I'll go back to we were talking about, actually we're talking about a lot of different things, but I do want to remind everybody, if you want to sign up for that seminar, it is going to be, let me get scrolled back there, Thursday, September 14th, going to start at 6:30. We're going to go for probably about a half an hour, take a little break, then come back over about 45 minutes. Everybody that shows up will be able to leave with a retirement plan, and it's a really good one. In fact, if it takes you more than 10 minutes, it's because you haven't been doing this for 30 years like I have. Which is probably going to take us more than 10 minutes because most of you have not been doing this for 30 years like I have. It's not as difficult as people make it out to be. And it's relatively simple. And that's one of the things I've found over the years. If you can find ways of making things simpler, but they've got to be effective now. You can't cut steps out that are important. But if you can find a way of simplifying your life, that's a pretty good thing. And in fact, the tool that we're going to be using is part of a service that we provide for our clients. Not only do we provide this website for them where they can log in, pull in all their financial information that they want to, including investments that I'm not managing. Did you know you could do that? If you're a client out there and you've gotten access to this, by the way, not everybody has access to it yet. We have to roll this out. If you haven't got it, don't worry about it. It's coming. And we're going to be sending out the emails fairly quickly. I was in last week. The reason we didn't have the radio show was I was in San Diego doing some training on this program. We've been using it for about 6 months now, and now we're getting ready to roll it out in a big way. So you'll be able to pull up your accounts and drill down into the positions. You'll be able to see the way they're allocated. It's super safe, as safe as it can be. You can't do any transactions on this website. So if somebody were to hack your website, password, user ID doesn't matter. It's not set up to do transactions. It's only set up to view. How cool is that? You can set up alerts on it, and it's got this retirement planning tool built into it. So if you're a client, you're going to have access to this for free. If you're not a client but you'd like to use it, we'll have it at a nominal rate. It's not going to be very expensive. So clients and non-clients can use this tool. And it's what we're going to use to do the retirement plans that everybody, when you show up, we're going to run through it. And I promise you, it's just not that difficult. When you've been doing this for a really long time, it's just not that difficult. I think it was something that, what did Einstein say about simplicity? And people who really mastered a subject, they could present it in terms that a child can understand. Something along those lines. I can't remember. I read so much stuff anymore. Anyway, I thought that was really interesting. The fifth level of genius. Yeah, that's what he called it. The fifth level of genius was simplicity. And I know what he was talking about. He was talking about when you get past all the little details and you've been able to assimilate all that information, the end result tends to be a relatively simple answer. By the way, he's not the first guy to realize that. There was a guy, I think he was a priest. His name was Occam, and they call it Occam's razor. The simplest solution is often the best. And so that's what I'm about. I like things simple. Yeah, I'm sure a lot of people think I'm pretty simple. That's okay. I'm not offended. Life is too short. But anyway, so we'll be doing the retirement plan, 10-minute retirement plan, stock picking 101. I'm going to put both of those in. They're both relatively short. They are simple. It's just not that hard. And I had this guy in the Starbucks the other night, and he's trying to convince me of stuff, and he doesn't realize how long I've been doing this. He doesn't know, and I'm just picking him apart. Every time he throws something out, I'm saying, okay, explain that. What is the math behind that? Do you know how to work this? Do you know what implied volatility is? And you could see he's getting frustrated, and I'm like, dude, no need to get frustrated. Go get a book and start studying. You don't need to be frustrated. I'm helping you out here. That's kind of funny, but that, I don't know if that's just an American thing, because I don't know that many foreigners to know whether other people in other countries like to talk about things as if they're an expert when they really know nothing about it. But anyway, he was a nice guy. He was a very nice guy. We were laughing about it. So I was just kind of joking with him, but a little spooky though, to think that somebody's actually throwing their money around out there and doesn't have any idea what the rules are. That'd be like playing poker and you're the only one at the table that's not looking at your cards. You're holding your cards up and showing everybody else, and you're betting, and without looking at them yourself. So you don't want to do that. Try to know as much as you can, and there are only certain things you really need to know, and a lot of things you just can't possibly know. And he was actually talking about a local company, and I'm not going to name because their lawyers may be listening. But it was a local company, and he's talking about all this stuff that the people that work inside the factory were talking about. And he doesn't even realize that they don't have access to the information that's really important. Nobody does until they release it to the general public. There's a rule that the SEC passed back in the 80s that requires a company to keep any news that might have a material impact, that means might get the stock to go up or down. They have to keep that news silent until they're able to release it to everybody at the same time. And I get people all the time at seminars and are calling me and saying, hey, I've got this inside information. Well, don't tell me. I don't want to go to jail, because that's what's going to happen. If that news that you have, and 9 times out of 10 times, actually it's probably more like 19 out of 20 times, it's not. It's just a rumor. So, but you wouldn't want to go around telling people that you have this inside information. That is crazy. Yeah, that'll get you into trouble. And if you do have inside information, don't act on it. They're going to catch you. It's not a matter of if. You don't have those high-priced lawyers like the hedge fund managers do. You won't be able to get out like Martha Stewart did. But anyway, so you have the access to the right information. Everybody does, by the way. There's actually I use a service that's a lot less expensive than my Bloomberg is. Can't wait till my subscription time is up on that thing. But the data that you need comes from a company called Y-Charts. They download it directly from the filings with the SEC, and they're updated every 15 minutes throughout the day. And I'm not getting paid from them, by the way, for this. I just really like the service. I think it's a good one. And it's actually called ycharts.com. And in fact, I wish I would have had it when I was talking to another gentleman a few weeks ago, because I didn't have my computer with me, and he was asking me some questions about it. And now I'm looking it up, and I see, very interesting. Company's got $1.5 billion in revenue. Was only down a little over 8%, almost 9%. It's really not that bad. They took a big charge against earnings, and so looks like they've reported net income of minus $220 million. That would not be a good thing. But the market value is only $95 million with $1.5 billion in revenue. So if they can find a way to stem the losses and cut their costs and get back in the black, this stock could really go. But that's a big if, and that's a big if. So it's kind of like JCPenney, same sort of situation when they've been reeling, trying to right the ship. They had a guy from, where did the guy come in from? I can't remember. It was some big firm, and he tried to turn them into like a Nordstrom's. And JCPenney shoppers are not Nordstrom shoppers, and it really hurt that company. They went from $18 billion in revenues down to about a little over 10, between 10 and 11. That's almost half. He lost almost half the clients. They've been fighting back. They've gotten up to the point where their gross profit margin is back to 35%. That's good. They're still taking some charges against earnings. That's not so good. The revenue is about $12.5 billion. That's good. That's up about 20% since they bottomed out. But they still have debt, so there's risk there. There's a lot of risk, actually. And I still own a little bit of the stock. Yeah, I've been in and out of call options on it and a lot of different things. Anyway, but I know what that is, and I knew what the risk was when I was buying it. So some of it I sold at a profit. So I'll probably be in that stock at least in some way, shape, or form until they either go bankrupt or go back up. One of the two. So I got to take a quick phone call. By the way, if you'd like to talk to us today, 216-901-0945, 216-901-0945. And I got Seth. You have a question?
Yeah, good morning.
Morning.
Wanted to know what you thought about Amazon and whether you think it's a good buy at this price.
And I'll pull it up. And Amazon's been very interesting. They spend a lot of money on new projects all the time. So it looks like their profitability is not as high as it is because they're constantly reinvesting into industries that require a lot of money to go into them, and a lot of them they get kind of accelerated depreciation on, which means the cash that they're generating is not accurately reflected in their profit statement, and it is really difficult to determine just how profitable they might be. But you got a company that with revenue, they're reporting revenue of $142 billion and a market value of $454 billion. That's a little bit steep. That's about 3 times. And I'm not sure exactly how they count their revenue. Are they counting their commissions? And I used to know the answer to this, so I apologize. I'll have to look back into that. If you want to call me during the week, I'll go ahead and look back at it. Every few years I've looked at Amazon. It's come up on scans before, and I've owned it that way. But those were very specific, kind of different than what we're talking about here. We're talking about it as a long-term investment. Some of the other programs I run, it was more of a shorter term in nature, not super short term, but several months anyway. But it looks like their profit margin, by the way, their gross profit margin's 37%. Now that is mind-boggling. That is absolutely mind-boggling that they got a gross profit margin of 37%. That blows me away. The quarterly growth in revenue was 22%. That's huge. 22 when you're doing 140 billion, 20% of 140 billion is $28 billion. Do you know how many companies don't have $28 billion in revenues in total? And that's
incredible.
Yeah, that's pretty wild. So, but anyway, if you want to call, it takes a little bit longer on a company like that because it's a lot more complicated. Amazon's really complicated, but I like what they're doing. I really like that. Jeff Bezos is that dude is he's got guts and he's super smart. So he's the CEO of that company, and they have no fear. they will get into anything. I heard a rumor, and I don't know if it's true, that they bought the Randall Park Mall. Are going to turn that into a distribution center, and I'm sure he probably got that for next to nothing. So that's pretty slick. But we'll see what.
You just look at Amazon. It seems like they're dominating everything.
They're trying to. They want to. I know they'd like to. Yeah, they've got a lot of projects too. One project, I forgot what it was. They're taking people into outer space, something like that. And I guess there are enough people around the world. You get the Saudis, the big oil sheiks, and maybe Putin. I don't know. That have enough money to pay for that. So that would be interesting. But yeah, it's an interesting company. You never get bored when you go to Amazon's the corporate page and look at all the stuff that they're doing. It's pretty amazing.
I'm just worried about antitrust stepping in and maybe breaking them up at some point.
Yeah, that's always a risk, especially with a company like them. That's just that's why you got to diversify. I would not put a huge portion of my money in any stock, really, because that can happen to just about anybody. No, look at poor Rite Aid.
What's the most you've ever put into one stock throughout your entire career, and was it successful?
Well, when I was young and dumb, I used to only hold 8 stocks. 8 stocks total. So I would have 12.
Wow.
Yeah. And that was very good, and you cannot get away with that today. That was a long time ago. Yeah, in fact, I was going through some old pictures today at a request of somebody that I really like a lot, and I was reminded of those times I was like, wow, boy, I look like a different person back then too. So that was a really long time ago. You couldn't get away with that kind of stuff today. Share prices the evaluations are all elevated, and the volatilities are incredibly high. So you come out with a company, and it can be down 40 or 50% in a matter of minutes. And that typically didn't happen that often back then. It did, but it just wasn't as frequent as it is today. So yeah, I wouldn't do it again today. If I were managing all my money myself, which means I would have to actually quit managing money for other people. Yeah, I would probably hold 20 stocks. And I'd have 5% positions in 20 stocks, and I'd probably limit that to about 70% of my money. So 20, divide 7 by 20, and that's how much I'd have in each stock. And if I couldn't find a stock, I would just leave it in cash. If I didn't find something that I had a lot of conviction on, I would just leave it in cash.
Do you prefer buying individual stocks to mutual funds?
Part of me does, and that's why I still do it. But I think for the general public, no. The general public seeing all the activity that occurs is not a good thing. It upsets them, and because they're not used to it. That's something that you really have to grow accustomed to. And so, yeah, for the general public, I think you're much better off with a core of funds, say maybe 70 to 80% of all your stock money that you're going to have in the stock market, you use funds for, and maybe you manage 20 to 30% of it yourself if you really like it. And and if you really like it, and then you get good at it, by the time you retire, then you can manage it all yourself, no problem.
Yeah.
And you have the time.
All right, Bill. Thanks very much. Appreciate it.
Hey, thanks for calling. Appreciate it. Have a good one.
Bye.
Yeah. So, wow, that section went fast. Hey, this is Bill Bullington right here on 1420 The Answer. We'll be back after these messages. And we're back. This is the Bullington Capital Report, and this is Bill Bullington reporting. Yeah, I'm corny. Oh, well. You just have to live with it. So the guy was talking about Amazon. By the way, I'd like to remind you one more time, we got the 10-minute retirement plan and stock picking 101 coming up Thursday, September 14th, 2017. pretty quickly. 6:30 Corporate College. Go to my website. It's free. These guys, by the way, they brought in some top chefs, so they prepare the refreshments and all that. And again, there's no cost to it. So feel free to drop on by. Go to the website to sign up, and we'll try to get you there. If you'd like to call into today's program, 216-901-0945, 216-901-0945. And I'm going to go to Chris. Chris, you got a question?
Yeah, I don't know if you're familiar with a stock called Sina, S-I-N-A, if you follow that one or not.
Not really. I know it. I've actually owned it because it's come up on a momentum screen every once in a while. But those momentum screens, though, they're okay. Yeah, actually, I do remember now. It's coming back to me. So,
all right, let me ask you a question.
Yep.
What am I missing here? What am I missing versus all the brains on Wall Street? Company has a market cap of $7 billion.
Right.
They own 46% of Weibo, which that alone is worth $9 billion. They got $2 billion in cash. They make $130 million in profit a year. Knowing the Chinese laws the way they are, because Weibo is like 30% owned by Alibaba, Sina could come out on their board of directors and say, "Hey, we're going to sell the stock for 5%, 10% more than it's selling for right now," and Alibaba can pocket about $3 billion by doing that. I don't get why this stock doesn't trade at a lot higher valuation.
Well, it only has revenue of $1.2 billion. So at a $7 billion market cap, you're paying $6 for every dollar's worth of sales. You're paying $33 for every dollar's worth of profit. So which is about a 3% return, which is not bad for a company whose revenue is up 47%. That's not bad.
Right.
The earnings actually were down quite a bit. They must have taken a charge against earnings. They probably made an acquisition somewhere. I don't know. I'd have to look into it. But the earnings were down quite a bit. But the revenue was up. Normally when the revenue is up and the earnings are down, it's because they're reinvesting or buying something, and then they're taking a big write-off. They're expensing something. The gross profit margin is 74%, which is awesome. The profit margin, though, is only 6.5%, which is not very good. But that could be because of the activity, mergers and acquisitions. So that's another thing. I would actually have to look into that more closely to figure out why. But based on the numbers, I'm looking at it going, yeah, no, a company that's that big and growing that fast in the business that they're in, it's not unusual to see them sell for 6 times revenues. Sometimes they'll get to 8 or 10 times revenues. I would much prefer that it would be somewhere around 2. That would be awesome, But companies that grow that fast typically never sell for 2 times sales. And if they do,
let me ask you this question. Let's say they shut down.
Mm-hmm.
They've got $11 billion of assets.
Yeah, but the market cap is $7 billion, and wait. In fact, it can't be $11 billion in assets because the price to book value is 2.7. So the book value is a conservative estimate of the assets minus the liabilities divided by the shares outstanding. So if the price to book value is 2.6, that means the market cap is 2.7, basically 2.7 times the actual asset value. So on that stand, it's not super cheap either. In fact, it's a little higher than average.
Well, Forbes came out with an article that said it was worth $75 a share, which didn't make any sense to me at all.
Well, that's opinion, and they're not a investment advisor, so they're just whatever they they got to fill pages to sell ads, and that's somebody's opinion. They pay them to have an opinion, actually, not to be right. But and I could see that, but you could say that about any company. Everybody has a right to have an opinion, especially in America, where you have First Amendment rights.
Okay. Well, I have an opinion that it's worth $130 a share.
Okay, yeah, that's fine.
That's my opinion.
Yeah,
Because,
you know what?
Just based on what they own, I just don't get it. I mean, I've done very well with this stock, and then they gave us a dividend that was like 10%.
Mm-hmm.
It worked out to 10% in that they gave out a share of Weibo stock.
Well,
for
average
every 10 of Sina.
The average number of buy recommendations is 13. There are only 19 people that are actually following the company, publishing their recommendations. So that's good. You've only got 2 hold, no underperform, and no sell recommendations. You got price target of 128. That would be if they took the price targets of all those analysts and put them together and took an average. That's what that is. By the way, I'm getting all this data from this company called Y-Charts, which is a really good deal.
Wow.
One of these days they'll probably pay me for that, but I doubt it. But it's a little expensive for an individual. I think it's like $40, $50 a month, but it's worth it. I mean, it's unbelievable that the level of detail that you get. I have the institutional version where you can actually do screens, so they charge me like $3,600 a year, but which is still pretty cheap. And but you don't need the screening thing. If you know what the stocks are, actually you can set up the free stock charts and scan for that, and then look up the detail behind it using the Y charts. So it's pretty cool.
Okay. How do you feel about Alibaba at this price?
What symbol is BABA on that? Is that what it is?
BABA.
Okay.
It's gone to like 170 some a share now.
Yeah. Okay. So this is a company that has $25 billion in revenue, and it's the market value of the stock is $434 billion.
Right.
It's selling for almost 10 times its asset value. Its price to book value is 9.87. So as much as I would like the company, I love the company. I wouldn't pay that much for it personally. I just wouldn't. I think it's pretty risky. So, but they do have a monster profit margin. Their net after tax profit margin is 30%. Think about that for a second. Net after taxes, 30%. That is crazy. That's like Microsoft back in the internet bubble. And their revenue growth was 48% quarter over quarter. So I wouldn't buy it as a long-term investment, because what will happen is whenever inevitably that growth rate does slow down, that stock is going to retrace a huge portion of the gains that it's made. And so I think that the risk is still pretty high. But, a lot of companies go from being obscenely overpriced to being grossly obscenely overpriced. So, you just don't know.
Yeah, they do.
Yep. So.
Hey, one more, if you don't mind.
Sure.
Facebook's starting to back off.
Mm-hmm.
At what point do you buy it?
I don't know. That's another one. You got $33 billion in revenues. You got a market cap of $483 billion. Okay, so it's selling at 15 times their sales, not their profit, times their sales. But the profit margin is so huge that the PE ratio is only 36, and their revenues were up 44% last quarter. That's another one of those that it's not a bargain. And
but it hit like 175. Now it's like 166.
Yeah, that's not a big drop, by the way. Percentage-wise, that's you're only talking a couple percent or so.
Yeah.
But
no, I know, but that's why I ask. At what point do you buy it? Do you buy it at 160?
I don't know. You're basically with that one. I would probably not. If you really like the company, just buy a little bit. Don't put more than 1% of your portfolio in there. If it goes up tenfold, woohoo! That's great. But if it goes down 50 or 60%, not too bad. And if it were to drop 50 or 60, or even like a 30% drop, I'd look for it to start coming up on some of my scans. The way that a lot of retail stocks, Abercrombie & Fitch came up. Abercrombie & Fitch was $25 in 2016. It was under 9 a couple weeks ago, and now it's at 12.34. And it's starting to move. Its price to sales ratio is 0.23. That makes, let me see, 0.23. That makes, wow. That makes Facebook's price to sales ratio, it's somewhere around 60 times higher.
Okay.
But it probably belongs 60, a lot higher because retail's been under fire. But price to sales ratio 0.23, big boost. And by the way, a bunch of guests and Urban Outfitters, when you see 3 or 4 stocks coming up on one of those scans at the same time, that means a mutual fund is allocating money to the retail space and they're buying all the stocks. So, yeah.
I've been watching Kohl's.
Mm-hmm. Well, Kohl's is Kohl's is more of a multiple line. It does a lot of like a J.C. Penney. The stocks that came up on these scans, they're like Abercrombie Fitch, Guess, Urban Outfitters.
Oh.
Those are like niche clothing stores. So and they're highly present in malls and the alternative to malls. By the way, that's been those like Crocker Park. That's the.
Well, that's why I'm looking at Kohl's. Kohl's doesn't seem, at least around here, doesn't depend on malls for it.
And Kohl's is okay. I'm not a real big.
It's got it's got a great dividend.
Yeah,
I haven't bought it yet, but when it falls into the third, when it gets under 40, I always feel like I should load up on it.
I don't know, man. It's been under 40. Actually, the long-term chart on that, it was selling at $55 in 2011. So I don't know. And actually, in 2000, it was around $80. It's at 39 now. So I don't know. I'm not a huge fan, but I haven't looked at it in a long time either. So, but I got to get running because I got about 30 seconds
no
left.
problem.
Hey, have a good weekend.
Okay.
Listen to Bill Bullington here every Saturday morning from 11 to noon on 1420. Have a good weekend, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.